Tonight, I've taught you all about Metanomics 101. But now it's time to turn to you. My viewers are smart, which is why my favorite part of the show, as I always tell you, is answering questions directly from you. Now, tonight, I'm bringing in Jeff Marks, my portfolio analyst, partner in crime at the CNBC Investing Club, to answer some of your questions. And Jeff, don't get a swelled head. Some of these callers have been calling in saying you do a pretty great job. Keep your head so we can get through the door here.
Thank you.
For those of you who are in the club, Jeff will need no introduction. For those of you who aren't members, and soon I hope you will be, Jeff's insight and our back and forth really are what we think is a major part of being part of the Investing Club. Thank you very much. All right, now let's get started. First up, we have a question from Jimmy, who asks, how can we identify the best companies within an industry? Now, I have a way that I like to do. I like to see who has the highest gross margins, because that means they've got the biggest moat. That means they can make the most money, and it's something that people don't look at enough, the gross margin.
Yeah, that's a great way to do it. You could also look at who's growing the fastest as well, revenues. But another way I think is really important is read the conference calls of the companies and their peers and their customers. See who's partnering with who. That will give you a good tell about who's best of breed, who has the best products, who's doing the best by their customers.
That's a really good point, because I find that in the conference call, you get a real sense of, by the way, of whether the analysts hate it or like it. You can often see by their questions whether they are in awe or they think that there's something that's suboptimal. So it's a great point to the conference calls. Now, next up, we have a question from Ian in Pennsylvania, who asks, you've stressed the importance of being diversified and also doing your homework. Is there a point where one individual can have too many different stocks to be able to keep up with the homework while staying diversified? I used to discuss this question with Pop, my father. He had usually like to have 40 or 50 stocks. And I would say to him, Dad, why do you have 40, 50 stocks? He goes, Jimmy, I work a couple hours a day, and then I spend a lot of time just looking at the market. So I like to look at a lot of stocks. Now, he had time on his hands. Most people don't. That's why I usually say that try to keep it to 10. Don't be a mutual fund on yourself.
Yeah, I think the benefits of diversification, they start to diminish at a certain point if you keep adding and adding and adding stocks. But that's 5 to 10. That's what we generally say for the club. Start what you can handle.
Pick the ones you like.
Yep.
Use your power of observation and curiosity.
And as you can do more of the homework, that's when you can start adding more.
Yeah, and I think that's a perfect situation. Next up, we have a question from Dean, also from Pennsylvania, who asks, I'm considering either an S&P 500 index fund or a total stock market index fund for purchase. Both seem to have very similar expense ratios and historical returns. What is the primary difference between the two? Which do you feel is better? Do you know that John Bogle personally told me, Jim, I want you to put in your 401k, I want it to be in the total stock market return fund of Vanguard. And that's what I did. And why did he want me to do it? He said, over the long term, you'll get a little bit better performance because you'll be diversified away from the S&P, and you'll end up picking some really good young growth stocks that are in the total stock market return.
Yeah, that's exactly the difference, right? S&P 500, that's going to be more of the large caps, while total stock is you'll have the mid caps, some of the smaller caps as well. But I think if you look over the long run, the returns aren't going to, there's not going to be much of a difference between the two.
And I did TSM.
You're fine in either.
Right, but I ended up doing it because the father of the index fund is John Bogle, as we know, and Jack said, Jim, this total stock market return will beat it. Now, there was a very long period where it did, but it's really kind of... Anyway, I'm just doing it out of homage to the late John Bogle, who was an amazing guy. All right, now let's go to Miles in New York, who asks, what are your stages in cutting bait? Now, I'm presuming cutting bait means when are we doing some selling? Up 20%, we like to do a little sale. Then up another 20%. We've been very, let's say, diligent about letting our great stocks run and cutting off the ones that aren't. That's the key thing. You let your great stocks run, but if you can minimize your losses and be more aggressive in cutting, you will outperform the market.
Right, and you always have to remember when your original thesis, when it's not playing out as expected, that's when you may have to make an adjustment. And I know in some of those cases, we've often learned that our first sale is the best sale when trying to get out of a struggling name.
Yeah, and I think that there's nothing wrong with admitting that you have a loss. What matters, as we were talking about the other day with Roger Federer, is you just win more than you lose. That's what you need to do. All right, now, you know what? We're going to have to save the rest of the questions for next time. So all I can say is, I like to say there's always a bull market somewhere, and I promise to try to find it just for you right here on Mad Money. See you next time.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.